Hey everyone, welcome back to Corporate Dakota. Today, OMDA just filed their quarterly report, and I am seeing a few things that paint a clear picture of their current situation. Quick note, this is not financial advice, just my take on public filings for educational purposes. Omada Health is showing some really solid growth, but they are also facing some big challenges that could make or break their future. This is their quarterly report, their 10Q filing for the period ending the 30th of June 2026. Think of it like a progress report for investors. Omada Health is a digital health company that helps people manage chronic conditions like diabetes and heart issues. They combine human coaching with technology. Let's dive into the numbers in their balance sheet, which is like a snapshot of what the company owns and owes. We see total assets at around $328 million. That is up from about $305 million at the end of the previous year, 2025. This growth in assets is a good sign. Now, accounts receivable, which is money customers owe them, jumped significantly. It went from about $34.5 million at the end of 2025 to over $56 million by mid-2026. This tells us they are selling more, which is great, but also that more money is tied up waiting to be collected. On the flip side, their total current liabilities, the money they owe in the short term, stayed pretty flat around $75 million. This is usually a good thing because it means they aren't suddenly owing a lot more money. Their total stockholders' equity, which is basically the value belonging to the owners, grew from about $229 million to $252 million. This increase in equity is another positive sign, showing the company's value is growing. Now let's look at how much money they made and spent. This is their income statement for the first 6 months of 2026 compared to 2025. Total revenue showed strong growth for the first 6 months of 2026. Revenue was about $165 million, up from $116 million in the same period of 2025. That is a 43% increase, which is fantastic. Most of this comes from their services, which grew from about $106 million to $150 million. This means people are using their core digital health programs more. Their hardware revenue also saw a big jump, going from about $9.8 million to $15.5 million. This likely means they're shipping more devices, like scales and monitors, to new members. But with more revenue comes more costs. Their total cost of revenue increased from $44 million to $53 million. The cost of services went up a bit, and the cost of hardware saw a bigger jump, likely due to the increased volume and potentially higher device costs. Despite the rising costs, their gross profit, which is revenue minus the direct costs of providing the service, also grew significantly. It went from $72 million to $112 million. And importantly, their gross margin, which is profit as a percentage of revenue, improved. It went from 62% to 68%. This means they are becoming more efficient at making money from each dollar of sales. This is a huge win for them, showing they are managing their costs better as they grow. Now let's look at their operating expenses. These are the costs of running the business beyond just making the product. Research and development expenses increased from $18.8 million to $27.3 million. This shows they are investing heavily in new programs and improving their technology, which is crucial for a tech-driven company. Sales and marketing expenses also climbed from $42.4 million to $56.6 million. This is necessary to acquire new customers and channel partners, but it is a big chunk of their spending. General and administrative expenses, which cover things like finance and HR, also went up from $23.6 million to $29.7 million. All these increased expenses led to a reduction in their operating income. They went from a loss of $12.7 million to a smaller loss of $1.2 million. They are getting closer to being profitable from their core operations, which is a very positive trend. On the other side, their interest income nearly tripled, from $1.4 million to $3.5 million. This is because they have more cash on hand, likely from their initial public offering, and they are earning more on their savings. As a result, their net income for the first 6 months of 2026 was about $2.3 million, a huge turnaround from a loss of $14.7 million in the same period of 2025. This profit is a critical milestone. Now, something important to note here is the number of shares outstanding. For basic earnings per S-Hair, it jumped from about 15,000 shares in 2025 to nearly 60,000 in 2026. This big increase in shares can dilute the value of each existing share if the company isn't growing fast enough. These notes provide more detail. For example, Note 2 talks about their accounting policies. They mention a reverse stock split in May 2025. This is often done to increase the share price, but sometimes it is a sign of underlying problems. Note 2 also discusses their initial public offering, or IPO, in June 2025. They raised over $172 million. This was a major event for them, providing a significant cash infusion. This section highlights a key risk for Omada Health. A large portion of their business, 56% of their accounts receivable and 33% of their revenue, comes from just two partners, Partner A and Partner B. These partners are both part of the Cigna group. This means if anything happens with Cigna, it could really hurt Omada. It is like having too many eggs in one basket. This is where the company lays out all the things that could go wrong. They face stiff competition from other digital health companies and even large established players. This is a constant battle to stay ahead. They are also highly dependent on their IT systems and are vulnerable to cyber attacks. A data breach could be disastrous, not only financially, but also for their reputation. This is a pretty serious red flag. They've identified a material weakness in their financial reporting. This means there are significant gaps in their internal controls, which could lead to errors in their financial statements. They are working on fixing it, but it is a concern that needs watching. Here they elaborate on that material weakness. They didn't have enough formal processes for their financial closing and reporting. This isn't ideal for a public company. Let's look at their key metric, total members. As of June 2026, they had about 1.1 million members, up from 752,000 a year earlier. This shows significant growth in their customer base. The revenue section details how they make money, mostly from services and some from hardware. It is interesting they mentioned that their top 5 health plan and PBM partners account for a huge chunk of their revenue, 79% in the first 6 months of 2026. This reinforces the risk associated with relying heavily on a few major partners like Cigna. The improved gross margin from 62 to 68% is really the highlight here. It shows they are getting better at managing the costs directly related to their services as they scale. This is a key indicator of improving profitability. Their investment in research and development, up 45%, shows a commitment to innovation, which is vital in the fast-moving digital health space. But that investment comes with higher sales and marketing costs, up 33% as they push to acquire new customers. Interest expense has dropped dramatically by 99%. This is great news, largely because they use some of their IPO money to pay off their loans. This part is management's own explanation of the numbers. They talk about their mission and how they help people manage chronic conditions. They acknowledge both the opportunities and the challenges ahead. This reinforces the risk factor about competition. It is a crowded market and they need to keep innovating to stand out. They have about $221 million in cash. This is a healthy amount, especially after their IPO, and they believe it is enough to keep them going for at least the next 12 months. They also mentioned paying off significant debt from a financing arrangement with mid-cap funding IV Trust. This is a big positive for their financial health. Looking at their cash flow, they used about $7.8 million in operating activities in the first 6 months of 2026. This is better than the $13.2 million used in the same period of 2025, but they are still spending more cash than they are bringing in from their daily operations. On the financing side, they brought in about $10.7 million in the first half of 2026 from stock options being exercised. In 2025, this number was much higher at $162 million, mainly from the IPO. This is just a list of all the documents attached to this report. These are certifications from their CEO and CFO confirming the accuracy of the financial reports. They are essentially saying, we stand by these numbers. These are also certifications, but specifically related to the Sarbanes-Oxley Act, a law designed to prevent corporate fraud. So, what is my take on Omada Health? They are definitely showing strong revenue growth and improving efficiency, which is impressive. The IPO provided a much-needed cash boost and helped them pay down debt. However, that material weakness in internal controls is a significant concern. It suggests some foundational issues in how they manage their finances. Plus, their heavy reliance on a couple of major partners like Cigna presents a concentration risk. The competition is fierce, and they are spending a lot on sales and marketing to keep growing. My biggest concern is that material weakness in financial controls. If they can't fix that quickly and effectively, it could undermine investor confidence and lead to bigger problems down the road. What I am actually looking for next quarter is clear progress on remediating that weakness. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.